Welcome to TalkTickers. We're doing a deep dive today into high roller technologies, specifically their first quarter 2025 results, fresh from the earnings call.
Right, and the big story here really seems to be a strategic shift. Q1 saw some revenue growth quarter on quarter, which is, okay.
Modest growth, yeah.
Modest, exactly. But it was definitely overshadowed by a much bigger operating loss compared to last year. This quarter sort of forced their hand, it feels like.
Okay, let's really get into that then.
Yeah.
We'll look at the financials, figure out why that operating loss jumped so much, and then unpack their big response, this major strategic realignment.
Yeah, they're really narrowing the focus, moving away from a broad approach to concentrate exclusively on regulated markets with high potential.
And those markets are specific ones.
Very specific. They called out Ontario, Alberta, and Finland. Those are the key targets now. We'll talk about the team they're assembling for this, product updates, customer acquisition stuff, how their affiliate brand casino room fits in, branding plans.
And the partnerships too, right? Like Spike Up Media, they mentioned them quite a bit.
Definitely. Crucial piece, they seem to think. And, management is really banking on this whole shift to improve cash flow and margins, but not immediately. More like the second half of 2025.
So some short-term, maybe pain for a potential long-term gain in these specific areas. A real pivot.
That's the narrative, yeah. Near-term adjustments, strategic bet on the future.
All right, let's start with those Q1 numbers. Total revenue was $6.8 million, you said. How's that stack up against last year?
It's about a 4% gross revenue increase compared to Q1 2024, so slight growth there.
Okay, 4%. What about the efficiency, the gross win margin?
That was interesting. It was 4.8%, but the key thing is that's a 4.3 percentage point increase year over year.
Wow, that's a big jump in margin efficiency.
It is. So when they won, they kept more of it. The problem wasn't really on the gross margin side of things.
Got it. So if revenue was up slightly and gross margin efficiency was way up, where did the bigger loss come from? The bottom line took a hit.
Exactly right. The net loss came in at roughly $3.3 million for Q1. That works out to about 39 cents per share loss.
And compared to last year?
That loss is 50% bigger? 50%. It's a significant jump downwards on the net result.
Oof. Okay, 50% bigger loss despite better gross win. What did management say was the main reason?
They were pretty upfront about it. Marketing spend, they put about $4.1 million into marketing just in Q1.
$4.1 million, how does that compare?
That's a massive 50% increase compared to what they spent on marketing in Q1 last year.
Okay, so spending way up. But where was that money going? Was it effective?
Well, that's the kicker. A lot of it went into what they called long growth territories. And their own words were the return on investment, the ROI from that specific spend in the quarter was less than attractive.
Less than attractive. Okay. That's usually code for.
Yeah, for it didn't really work or certainly not well enough.
Right.
And that poor ROI, that kind of inefficient spending, that seems to be the direct catalyst for this whole strategic pivot we're talking about. The numbers really force the issue.
So this realignment plan is their answer to that inefficient growth problem.
Absolutely. It's a direct response. They basically acknowledge the old way wasn't scaling profitably. So the new plan is laser focused on just those few regulated markets.
Ontario, Alberta, Finland.
Exactly. And they did acknowledge, that winding down operations elsewhere might dampen the top line revenue growth in the short term because you're cutting off some existing revenue.
So that makes sense.
But the bet is that this creates a more stable, more profitable foundation for the future, future-proofing, essentially.
And to pull off such a big shift, they've brought in some new people, right?
Yeah.
Some experienced folks.
Yeah, they've definitely strengthened the team and the advisory side. You've got Daniel Bransky and Robin Reed joining a strategic advisory board. Bransky's focused on finance. Reed's stepping in as interim CMO.
Okay.
Then there's Seth Young joining the leadership team for corporate strategy and IR, bridging that gap between the strategy and the market. And Emily McAuliffe as chief of staff, kind of managing the execution of this whole reorganization.
Seems like they're bringing in serious players to manage this transition.
It signals they're taking the execution part very seriously, yeah. High-level hires.
And product-wise, were they just focused on strategy or did the platform see updates?
No, they kept adding to the platform. Added over 750 new games in Q1 alone.
750, that's quite a lot.
Yeah, it brings the total game library to over 5,300 games now from more than 90 different providers. And importantly, for these regulated markets they're targeting, 15 of those new games were exclusive first market opportunities. Gives them something unique to offer.
Okay. And they also mentioned something about refreshing the brand identity.
Yes, for both High Roller itself and their other brand, Casino Room. They're doing this sort of in preparation for these new market entries, wanting a fresh look as they go into Ontario and potentially others.
Makes sense. Let's look at customers. Were they still acquiring players during all this?
They were. They added 30,000 new active depositing customers in Q1.
And how does that compare?
That's up 34% from the same quarter last year. So player acquisition itself was happening.
But the cost was the issue, right? Back to the marketing spend.
Exactly. Attracting players wasn't the problem. It was the cost of attracting them in those long growth territories that wasn't sustainable. Which brings us right back to the strategy shift.
Right. So how does Casino Room, their affiliate brand, fit into this new, more focused picture?
Yeah, Casino Room is an interesting angle. It actually brought in nearly $1.6 million in revenue in Q1.
Okay. Significant chunk.
It is. And the plan now is to keep Casino Room running, but purely as an affiliate model, specifically targeting emerging or like non-core markets.
So low overhead, less regulatory hassle.
That seems to be the idea. Generate some revenue, expand the brand reach a bit, but without the operational complexity or direct regulatory burden of the core High Roller brand, which is going all in on direct operations in those target regulated zones. It's complementary.
Let's talk more about those target markets then.
Yeah.
Finland, Ontario, Alberta. Why these three specifically?
Management gave a few reasons. First, the team apparently has a lot of prior experience operating in exactly these places.
Okay, familiar ground.
Yeah. Second, the customer base in these markets tends to be, relatively educated, often moving from gray or unregulated markets into regulated ones. And the user behavior, what games they like, it's apparently quite similar across all three.
Interesting.
And they also just rank really high globally for things like customer engagement and, importantly, value per player.
Yeah.
High value market.
Ontario's the big one, right?
Yeah.
It's already a massive regulated online gambling market.
Oh, huge. One of the biggest in the world now. High Rollers got their initial license application in for Ontario. They're actively prepping for launch there, aiming for the second half of this year.
And the potential there is.
Well, Ontario as a whole, since regulating, has generated over $5 billion in total revenue. Management estimates the annual market opportunity there at nearly $2.5 billion.
Wow.
Yeah. And they pointed out, look, even if we only capture 5% of that market, that's still a $125 million annual revenue business. Puts their current, $6.8 million quarterly revenue into perspective, doesn't it?
Definitely highlights the scale they're chasing. And Alberta is next in line.
Seems like it. Alberta just passed Bill 48. Assuming it gets royal assent, it sets up a similar regulated framework to Ontario.
So High Roller sees Ontario as a stepping stone.
Yeah, kind of an anchor for Canada, potentially North America. They plan to apply for an Alberta license as soon as that framework is actually finalized and open for applications.
And Finland. That's one where they already operate significantly.
Exactly. Finland actually makes up a big chunk of their current net gaming revenue already, something like 60%.
50%, okay.
Yeah. And Finland, like Alberta, is moving away from a state monopoly towards an open, competitive, regulated market. So given High Roller's existing presence, customer base, and revenue there, they see this regulatory shift as a huge upside opportunity. They'll definitely be going for a license.
So executing this, leaning on the team and partnerships is obviously critical. They really emphasized Spike Up Media, didn't they?
They really did. Hammered that point home, talked about their own team's deep iGaming experience, veterans who've been around the block. But the Spike Up relationship was framed as a potential game changer.
Game changer is strong language.
Yeah.
What's the logic behind that claim?
Well, the belief or the pitch is that Spike Up has the experience, the tech, the creative team, the influencer network, all geared towards getting customers much cheaper, basically. Lower cost per acquisition.
Specifically in regulated markets.
Yes, that's the key. And delivering a higher return on ad spend in regulated markets compared to what High Roller was doing before, or even what industry averages are.
Okay.
Spike Up apparently has a long track record, claiming they've driven $600 million in player deposits over 15 years. So the core idea is this partnership is how they'll make the marketing spend in Ontario, Alberta, and Finland super efficient. Avoid that less than attractive ROI problem they had in Q1.
So the success of this whole pivot really rides on Spike Up delivering.
It seems heavily reliant on it, yeah. Especially for hitting the ground running efficiently in Ontario. That promise needs to materialize.
And beyond the execs, the board and advisors are strong too.
Yeah, quite diverse. The board has public market governance experience, connections to Spike Up, actually, gaming entrepreneurship experience, HR expertise, tech leadership. including the former CEO of Mojang Studios.
Mojang, Minecraft.
The very same. And the advisors add more digital marketing and iGaming cred, including like an iGaming Hall of Famer. It looks like a roster built to navigate these regulated markets and the public company side of things.
Okay, one crucial question then. With the bigger loss this quarter, the costs of this whole transition, what about cash? Do they have enough money or do they need to raise more?
Good question. As of March 31st, end of Q1, they reported having $4.5 million in corporate cash, plus another $1 million restricted.
And management thinks that's enough.
They stated on the call they expect that existing capital is sufficient to get them through this transition period and into the new market launches. They explicitly said they don't foresee needing a capital raise anytime soon.
Okay.
The expectation is that cash flow should start looking better in the second half of 2025 as they stop spending in the old markets and, optimize costs for the new regulated focus.
All right, this naturally brings us to that part of the deep dive, the disclaimer zone.
Right. And let's be absolutely clear here. This part is purely for informational and entertainment purposes. It is not financial advice. Investing carries significant risk.
You must do your own research? Consult with a qualified financial advisor?
Yeah.
We're just talking hypotheticals based on the call.
Seriously, do your own homework. Okay.
Absolutely. So with that bright line drawn, let's explore an outrageous but plausible trade idea. Something purely hypothetical, highly speculative, based only on what management presented.
Okay. So given this extreme pivot, their stated reliance on Spike Up Media being a game changer for efficient customer acquisition, specifically in Ontario, a really speculative, high-leverage way to play that narrative could be maybe looking at far out-of-the-money call options on the stock.
Expiring when?
Expiring maybe late 2025?
Okay.
After that H2 Ontario launch window.
So this is a bet on absolutely everything going perfectly right, triggering a massive stock move.
Pretty much. The entire rationale hinges on, 1, flawless execution of this strategy shift, and 2, Spike Up actually delivering truly exceptional market-beating customer acquisition results in Ontario.
Like hitting big market share numbers fast, super low acquisition costs.
Exactly. If that happens, and maybe you get some positive news flow on Finland or Alberta regulation moving quickly too, then the market might suddenly reevaluate the company completely, seeing them not as they are now, but as this potentially fast-growing, super efficient operator in prime regulated markets. That could unlock a lot of value, theoretically making those far out-of-the-money calls valuable.
But it requires perfect execution. Spike Up working miracles, and positive external factors all aligning.
Absolutely. It's betting on the absolute most optimistic scenario playing out based on management's specific narrative from this call. Pure speculation on that narrative becoming reality.
Which, one last time, is not advice. Just an illustration of a potential high-risk, high-reward angle based on the call content itself.
Please be careful out there. This is just talk.
Okay, so let's wrap up this deep dive on High Roller Technologies Q1 2025 call. We saw modest revenue growth, yes, but also that big jump in operating losses.
Driven mainly by marketing spend that just wasn't efficient, which directly led to this bold strategic pivot. Focus now is purely on Ontario, Alberta, and Finland.
And success there relies heavily on the team's experience and, critically, on this Spike Up Media partnership, delivering that promised game-changer efficiency in customer acquisition.
Right. Management expects things like cash flow and margins to look better by the second half of 2025 as this shift takes effect. And they believe they have the cash on hand to make it through the transition.
So the big question hanging over everything is execution, isn't it?
It really is. Can they manage shutting down the old stuff while launching flawlessly and efficiently in these new competitive regulated markets, especially Ontario? Can Spike Up really deliver? That's what you need to watch.
We hope this breakdown of the High Roller earnings call gave you some good food for thought on their strategy, thinking about that execution risk versus the potential upside if they nail it. That's the core tension here.
Yeah, definitely look beyond just the Q1 loss number and try to assess if you believe in this new focus strategy and their ability to pull it off.
Thanks for joining us for this deep dive. We'd be interested to hear what you think your takeaways on High Roller's pivot or the potential in these markets.